Today, we're going to talk about value investing, and we're going to take a little journey all the way back from Benjamin Graham to Buffett, which I think is appropriate since if anyone is paying attention, Berkshire Hathaway is doing their annual meeting right now. So we'll see how that goes. But first, all the housekeeping items. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you are in New Zealand, you can go to our website and find our FAP on our website. And if you want any personal advice, you should go talk to a financial advisor. So there we go, catering for New Zealand's new regulations. The other thing is I would love questions. So there's a Q&A button at the bottom of this thing. So click on that and send through questions. And also, we were talking before this, we're almost at our 100th webinar since we started these things last year. And we're thinking of a special 100th webinar topic. Most of the suggestions before we started would involve me getting fired, but if you have any ideas for that, send it through. Okay, let's get started. Okay, so we're going to go through the history of value investing. And this morning, Shani came into work and said, "What's today's webinar on?" And I said this was it, and she goes, "Wow, that's boring." So we're going to try to make this not boring. Okay, so first we're going to talk about Benjamin Graham. So put up a quote there from Phil Fisher, which is a little bit confusing. But anyway, let's talk about Ben Graham. So Ben Graham wrote two very famous books that you see here. So the first book he wrote was Security Analysis on the left. That is a textbook at the end of the day, so you can read it if you want. But he published that in 1934. And then in 1949, he wrote The Intelligent Investor, which is one of the most famous books in investing, which is less like a textbook. But I'd warn you, well, I'll get into the warnings in a second. It's a good book. We'll talk about why it's important. But how about a little bit about Ben Graham to begin with? So I put some effort into these slides, which is a new thing. So what we're looking at here, did you say wow?
I said wild.
Wild. Cheers. All right. So what we're looking at here is the S&P 500. And so we're going to use that to talk about people's careers, particularly Ben Graham's and Warren Buffett. So a little bit about him. Ben Graham went to Columbia University, and he moved on to Wall Street after that. As you can see, began his career right at the beginning of the First World War. And of course, he did pretty well. And right here in 1929, he, of course, was in the middle of his career. That, of course, was the stock market crash that caused the Great Depression. And what he wanted to do after that happened, he obviously saw a lot of speculation that was happening up to that time. What he wanted to do is put a framework around and professionalize basically investing. And so that is the point of these books that he published. So he started out, of course, with Security Analysis, and we'll get into some of the specifics. Then, of course, The Intelligent Investor. Now, he was investing, obviously, when he was writing these books at a very, very different time. The stock market had gone down a lot, and things were very, very cheap. And so you just have to take into account that that is the environment he was writing these books in and he was operating in. So the majority of publicly listed companies were, as he said, grossly undervalued. So 30% of the companies that are listed on the New York Stock Exchange sold for less than their net quick assets. So what is net quick assets? It is cash, marketable securities, and receivables, so basically money owed to them by someone that they've sold goods to, minus their current liabilities. So this is absurdly cheap. There is nothing out there right now that even closely resembles that. And we'll get into why. But so what he did is he started working as a professor while he was still an investor at Columbia. So that is where he started writing these books, and him teaching will be important in a little bit. But let's talk a little bit about The Intelligent Investor, because that's the book that you're probably most likely to read. So The Intelligent Investor has two very famous chapters, and they're two chapters that Buffett says are the best chapters in investing and the foundation for everything. So they're chapters 8 and they're chapters 20. We'll start talking about chapter 8. I will warn you that the rest of the book is rather dry. And as you're going through chapter after chapter, as he talks about railroad bonds, you do wonder how relevant that is to what's going on now. But at least some of the things that he came up with in chapters 8 and 20 are timeless, and we'll talk about how they're timeless. So in chapter 8, he introduced Mr. Market. So Mr. Market's one of the most famous things in investing, and that's really, he created a personification of the stock market in this character, Mr. Market. So who is Mr. Market? Well, Mr. Market at the end of the day, and you can read the quote up here. So Mr. Market is going to show up every single day as an investor, and he's going to tell you what you can sell all your securities for and what you can buy new securities for. And he used Mr. Market to talk about market fluctuations and the difference between price and value. So in chapter 8, Ben Graham talks about there are two different ways that you can invest. So one way that you can invest is you can, of course, speculate. And he makes a very clear distinction between speculators and investors. And of course, he's coming out of 1929, where there was a lot of margin involved, so people borrowed a lot of money to go out and purchase securities, and they didn't spend any time trying to figure out what any of them were worth, and they didn't have to because the market was just going straight up during the 20s. I don't know if that sounds familiar to anyone, but anyway, what he describes Mr. Market as, and this is somebody else that came up with this analogy, that Mr. Market is a manic depressive. So he will happily pay more than objective valuations when the market is going up. And when the market goes down, he is desperate to dump all of his shares on you. And if you are a speculator, what you're trying to do is trying to figure out where that next market movement is. If you are an investor, you are just going to stand back, focus on companies, focus on what they're worth, and then look for opportunities when there are large differences between value and price. And I think an important thing to remember is Mr. Market here is all his job is to provide you with prices. But as an investor, you have to decide whether you want to take advantage of them or you don't want to take advantage of them, and you don't have to. And one of the things that is good about the stock market from a liquidity standpoint is you're going to get pricing every single day, every minute, every second of a day while a market is open. So that is good from a liquidity standpoint. It means you can go out and certainly sell your shares. But it's also very, very bad from a behavioral standpoint, because more and more when you can keep checking price all the time, you're going to equate price to value, which is not a good thing because they can deviate significantly. All right, so let's move on. The other chapter, as I said, chapter 20 of The Intelligent Investor. And we have a good quote right here. And basically what he introduces this concept of margin of safety. And what margin of safety means at the end of the day is that while as investors we should focus on value, we also have to have the intellectual humility to realize that we cannot go and absolutely know the value of anything. So to protect us from the imprecision involved in calculating the exact price that something is worth, and we went through, a couple weeks ago, we went through a How to Value a Share webinar that's available on YouTube or our website, where we talked about a discounted cash flow model and how you calculate the value of a share. But it's also, and I pointed out, it is very, very dependent upon what you're actually putting in there, what you're modeling out, and you're modeling out the future. So that's why we want to make sure that we account for imprecision in that calculation, and we do that for with a margin of safety. So all that means is that if you think something's worth $20, you shouldn't pay $19.50 for that. You need to build in an adequate margin of safety to protect you from imprecision in that calculation. And then just the fact that as a buyer of any equity, you are buying the future prospects of that company, and the future is, of course, unknowable. All right, so in these two chapters, there are three very important things that Graham, that hopefully I've talked about a little bit, but I'll summarize, that Graham talked about that are timeless. So even though you read all these chapters on railroad bonds and everything else, what are the timeless things we can take out of Graham? Okay, so number one, a focus on valuation is I cannot speak. A focus on valuation is what differentiates speculators from investors. So speculators don't care what anything is worth. All they care is what somebody will pay for it tomorrow. So that's the important one. The next thing around Mr. Market, so fear and greed are two driving forces of investors. So there's a theory out there. We actually had a reporter come in that was talking to us about this the other day around the efficient market hypothesis. The efficient market hypothesis assumes everything is always perfectly priced. Well, it has been thoroughly debunked. And why? Because people do not act rationally. So fear and greed can cause wild swings at the market during specific times. Doesn't mean all the time. The market can be mostly efficient, but still go through these enormous fear-driven or greed-driven swings. And that is what causes large differences between value and price. And as investors, the risk that we take on is volatility, but we can also profit by that volatility. And that comes from not following the herd. And then the last point that we just went through is margin of safety. So you need an adequate margin of safety between the price of something and the value, and that's the basis for successful investing. All right, so let's talk a little bit about Ben Graham as an investor instead of an author, and this will sort of transition us into the Buffett parts of things. So he was a value investor, and part of the reason that he was a real value investor was because there were so many values in the market. So we all have to be creatures of our own time and invest according to the opportunities that we have. So Buffett famously described Ben Graham's approach as cigar butt investing. So what cigar butt investing means, and I'll use a Buffett quote here, that it is the stub of a cigar, and Buffett says, though the stub might be ugly and soggy, the puff would be free. So once that momentary pleasure was enjoyed, no more could be expected. So what does that mean? I'm getting weird looks out over here. What does that mean? It basically means that he is going through the trash trying to find stuff that is decent, like one of Shawnee's friends who eats out of the dumpster. But that is a whole different webinar. So anyway, he's going through the trash and trying to find stuff. And by going through the trash, he's going through absurdly cheap companies that are selling less than basically their cash and their receivables, and hoping that he finds these companies and they can either be liquidated or they can or he can get that last bit of value out of them. But that is not being a long-term investor that's trying to compound over many, many years in companies he buys. Now, the other interesting thing about Ben Graham is he did not care at all about the business. So he didn't care what they were doing. He didn't care what the company was selling. All he looked at was the balance sheet. And that was the way that he invested. And once again, that was fine for the time because everything was selling so cheaply, and he built very large portfolios. Once again, going with if I go out there and buy all these 30-cent dollars, more often than not, this is going to play out for me, regardless of what the business did, regardless of management. He wouldn't talk to management. He just had no interest in the business. He had interest in looking at the balance sheet, and that piece of paper, that audited financial statement, was going to tell him every single thing that he needed. All right, so let's move on to Buffett. So Buffett, and this is a young picture of Buffett. So Buffett took Ben Graham's class at Columbia, and famously after Harvard Business School didn't let him in. So something they probably regret now and probably have regretted for a while. But Buffett goes to Columbia because he had read The Intelligent Investor. So he goes to Columbia and he takes his class. And he graduates from Columbia. So you see, he took his class in the early 50s. He graduates from Columbia. He actually spends a little bit of time working for Ben Graham. So he sat there and begged him to come work for his partnership. So he worked for Ben Graham. Then he goes back to Omaha, Nebraska, and he started this thing called the Buffett Partnership. And basically, the Buffett partnership was investing his parents' money, the little bit of money he had. Now, remember, Buffett had been investing since he was a little kid and famously had all these different jobs that he would do to try to get more money so he could invest it. So he had a little money on his own. His dad was rather well off. He was a congressman for a while. And so he went back to Omaha, invested his parents' money and his parents' friends' money and a little bit of his own. And that was his Buffett partnership. So he started the Buffett partnership when he was 25 years old in 1956. So $100,000, he would have invested $100,000 with that. 12 years later, you would have had $1.7 million, which is really good. So he had an annual compound return during the Buffett partnership of 29.5%. And the Dow, including dividends over that same period, returned 7.4%. So that's really, really good. So this is a quote that Buffett came out with at the end of the Buffett partnership. So we get to 1969. So if anyone listened to our podcast on lessons from crashes, one of those crashes we talked about was the Nifty 50 crash. So during the 60s, we had this huge run up, and you can see it here. That's why we have this convenient chart, that was described as wild. We have this convenient chart. We see the run up in the stock market to the 1969. So basically in 69, Buffett just quit because he couldn't figure out what was going on in the market because he was a Ben Graham pure value cigar butt investing investor. So got up to 69, he didn't know what to do anymore. And so he sat there and he said, and you can read the quote right there, he doesn't know what the game is anymore, so he's just going to quit playing. So he closes the Buffett partnership, gives back the money. Now, the market went up for a couple more years. It was actually in 72, I think, that it had a really big crash. But anyway, Buffett ends this partnership. And Buffett did something right before he ended this partnership. He bought this little company called Berkshire Hathaway. Now, Berkshire Hathaway was a textile manufacturing company in New Bedford, pretty close to where I used to live in Boston. And he bought it basically because it was one of these Ben Graham companies. So the textile industry in the U.S. was shrinking significantly as production moved off to Asia. But Buffett thought, okay, here's a company that has a lot of assets and they can probably sell a lot of this stuff off and I'll make some money. So he kept buying Berkshire Hathaway, he kept buying this company until he was pretty close to a controlling interest. And there's this story where the CEO of the company, Berkshire Hathaway, goes to Buffett and he's like, I want to buy you out. Like, who is this kid out in Omaha that's acquiring all these shares? I want to buy you out. And they agreed on a price. And apparently the guy tried to cheat Buffett, and this is back before decimals were used in stock prices, where things were priced in like an eighth, things like that. And when he got the official letter from the CEO who he had negotiated with, it was for an eighth less than what they agreed. And Buffett got mad at him and said, well, forget this. I'm not dealing with this guy. He's not honest, and kept acquiring more shares and eventually took over a controlling interest and fired him. So yeah, don't mess with Buffett, or at least young Buffett. So anyway, he bought this thing while he was still running the partnership. But when he unwound the partnership in 69, he decided that he would keep this company, Berkshire Hathaway. And so he took basically his share of the partnership out in shares of this company. And most of his net worth was actually in it. So anyway, there's all these quotes that go back, and he talks about how it was actually a mistake to buy it. And a lot of that is because of the change in his investment philosophy. So the other important thing that happened to Buffett is he met this guy called Charlie Munger. So Charlie Munger was also from Omaha. And Charlie Munger actually, so Buffett's grandparents ran a furniture store or a grocery store, and Charlie Munger worked at his grandparents' store. But anyway, he got introduced to Charlie Munger. Charlie Munger was a lawyer out in California who slowly started to get more into investing, and he invested in a very different style than Buffett. And the two started trading notes, started talking to each other, and Berkshire Hathaway, basically what Buffett started doing is using that company as a way to acquire other companies. So that's basically where a lot of his investments came from Berkshire Hathaway, which he, of course, personally controlled. So they bought this company called See's Candy in 1972. Someone should wake Shawnee up at this point. She loves this history. So See's Candy is a candy store out in the West Coast, and for Buffett, they paid a lot for See's Candy, and this was when Munger convinced him that quality actually matters. So this was when he started changing from this Ben Graham investor that was looking for these cigar butts, looking for these very, very cheap companies, into an investor that was actually looking for quality. And part of this really just fit Buffett. So we talked about Ben Graham and how Ben Graham didn't care what the company did. He didn't want to talk to management. He didn't want to know about the business. None of this actually mattered. He ran these big portfolios with lots of different holdings on it. Well, Buffett was actually really, really interested in businesses. And he was interested in what makes one business better than another. And at the end of the day, what he's starting to look at, and the evolution he goes through, is he isn't just looking on the balance sheet. So Ben Graham, and now we'll get a little into accounting, and Shawnee's mother thinks she's an accountant, so she could come on and explain this. We'll get a little bit into accounting. So what did Ben Graham look at? He looked at tangible assets. So a tangible asset is something that is on the balance sheet that you can go see. It's a physical thing. It's a factory. It's cash in the bank. Those are tangible assets. And what Buffett started looking at is, okay, what are the intangible assets? So something that can't be measured on a balance sheet. What are those, and how can we use those to try to determine if a company is great? And so this is kind of the evolution. And of course, Charlie Munger joined Berkshire, so we have that there in '78. And he's now, if you go watch any of the videos, he's sitting up there on stage. He's 90, God knows how many years old, a lot. 90, a lot. Is that a technical term? But yeah, basically, Buffett and Munger evolved into taking a different approach with investing. And you know what Buffett has said, and he still very much is an acolyte of Ben Graham's and recognizes what he's done for the investment industry, but he does recognize that the world changed. So Ben Graham was investing at a very, very different time. And he was investing at a time where he could go out there and buy all these companies, trading well below book value, even trading well below working capital, as we were saying. And you know, I think Buffett does continue to say that the principles that Graham establishes, certainly around margin of safety, certainly around Mr. Market, are ones that still stand to this day. So if you want to read something interesting, Buffett wrote this essay that he gave a speech. Sorry, I think he gave a speech at Columbia Business School. He went back for some anniversary. Buffett, and it's called The Super Investors of Graham and Doddsville. So Dodd was another professor at Columbia at the time. So go read that. It's a really interesting speech that looks at the disciples of basically Ben Graham. So these are the people that worked at Ben Graham's partnership, and sort of what happened to them all. And they all became very famous investors, and all took different approaches to investing. But you should read that if you. It's not too long, so if you want something interesting. All right, so let's keep going. Wow. We have definitely had that slide before. Am I going the wrong direction? All right, so I wanted to talk about a specific company. Why do I have so many notes? I don't know what's going on. All right, and we're going to use Apple as an example. And this slide's a little bit old, so Apple is actually a lot higher than that. I should have updated this slide. That's my fault. But anyway, don't look at the price. Just know it's gone up. So let's talk a little bit about Apple. So Apple, I think, was a good example. So Apple is a giant holding of Berkshire Hathaway. So there's been some news recently in the third and the fourth quarter. Berkshire Hathaway, third and fourth quarter of last year, Berkshire Hathaway sold 57 million shares of Apple, which everyone took, oh, does he now hate Apple? Well, interestingly enough, 48% of his portfolio is still in Apple. Or sorry, 48% was in Apple, 43% of his portfolio is still in Apple. So let's just say that he likes Apple. So anyway, I don't know what's going on with this slide. Did I just paste something on top of something else? Yeah, jeez. I need an intern or something, I think. They are all in the U.S. We used to get U.S. interns because they were free. I don't know if I should be talking about this, but anyway, we used to get U.S. interns because they were free and we wouldn't have to pay them. But of course, that is over now. So it's part of a program. They get college or they get university credit. Don't look at me like that. It's legal. It's just not legal. Anyway, let's talk about what epitomizes Buffett's investing. It's the idea of a moat. So he was the one that popularized this term of a moat. And a moat just means a sustainable competitive advantage. I know I've talked about this many times. So he popularized the term. Our analysts use moat. So what does a sustainable competitive advantage mean? This will be my 30-second description of this thing again. It basically means that over time in capitalism, there's competition. And that, of course, benefits us as a consumer. So what does that mean? It means that somebody invents a product, and most likely someone else is going to copy that product. And as the companies compete, they will compete on the quality of the product, which is good for us as consumers, and they will compete on the price of the product, which is also good for us as consumers. That's not great for us as investors, right? So if we have a product as a company and somebody else comes up with a product, we're going to lose market share. Also, of course, as we have to lower prices to compete, we are going to lose margin. Both of those things are not great for us as investors. That's why we want to invest in companies with moats. So that is a sustainable competitive advantage. And in this very confusing slide where I pasted, all right, I'm going to fix something. Watch this. This will be exciting. Look at that. All right, we fixed it. Okay, so and we'll show some of the benefits of these moats. We rate companies with different types of moats. We have wide moat companies. So wide moat companies are companies that have a sustainable competitive advantage that lasts for more than 20 years, or our analysts believe will last for more than 20 years. We have narrow moat companies that we believe will last 10 years. And then we have companies that have no moat. So these are basically all of, and this data is a little bit old, so sorry, I need to update this. Basically, this is looking at our wide moat companies, our narrow moat companies, our no moat companies, and you can see where you're going to start to see some of the impacts of having a sustainable competitive advantage. So let's talk about return on invested capital, so both 3-year look back and trailing 12 months. So what does that mean? It means that companies that have moats, of course, are able to invest in that company at a higher rate of return than other companies would be able to. So you can see the return on invested capital is much higher for these companies, both over trailing 12 months, 3-year period, and 10-year period. The other thing, of course, is operating margin. So that means they are going to make more money for every dollar of goods that they sell. So that's another important thing. And we've got two different margins, operating margin and net margin. How does this play out with Apple? So let's go look at Apple. And so once again, the data is a little bit old, but he started buying, so Buffett started buying Apple in 2016. And you can see all of these different measures, so return on assets, return on equity, return on invested capital, all significantly higher than the index that Apple's in. So that's the S&P 500 right there. Same thing with margin. The margin is significantly higher than the margin of the index, and we can see that over time. So that is an example of how Buffett's, and he would have never bought Apple because Apple is not cheap and was not cheap in 2016. Now, our analysts think it's pretty overvalued right now, just so you're aware, and we can go look it up on the website in a second. But that is the evolution of his approach to investing, where he started trying to find great companies at a reasonable price. And that's where this quote comes in. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And Buffett will argue, and this is Charlie Munger, by the way, who's older than Buffett. I just read a book on Charlie Munger. He's a bit of a nut job, but obviously a very successful investor. And that's, my own opinion. I don't think I'm allowed to. Well, anyway, we'll keep going. I'm saying a lot of stuff I shouldn't be saying between the trash, the interns, and calling Munger a nut job. Maybe this one we won't put on YouTube, Will. What do you think? Maybe this can be the 100th episode. Anyway, Buffett still says that he still adheres to the principles where he focuses on value. He's just realizing now that value comes from other things. Value comes from these things that create moats, whether that's the brand of a company, for example. And we can go through all the different moat sources as well. All right. So there's just a rush to answer questions. Lisa has more of a comment than a question. Maybe one needs to be a nut job to be a successful investor. Perhaps. I don't know where I stand in that nut job scale, but I'm sure the people that know me would say something. Lisa sent me pictures of her alpacas having lunch this weekend, which was nice. So thank you for that, Lisa. All right, if people have questions, you should ask them, or this is going to be, that's just a comment from someone in the room. Okay, so we're running out of questions. Let me show you one more thing, and then this might be a short one. I like to think that we don't have any questions because everything I explained is so clear. Nobody's buying that. All right, let's look at one more thing, just so I can update us on where we are with Apple, and I'll show you where you can look at our moat ratings. All right, so you can see here, Apple, it's actually, I didn't take that from today, did I? I guess it is a similar price. My fault. Yeah, you can see that we think Apple's pretty overvalued, so we think it's trading at a 15% premium to our fair value. So we very much, and one of the reasons why I talk about certainly going back to Graham and Buffett, and this is not unique, by the way. This is not unique in the investment industry. You will hear people talk about moats all the time, and certainly valuation, but that's the cornerstone of our research. So the different concepts we talked about. So let me talk a little bit about them. So number one, our analysts focus on valuation. So that's this fair value, $115. So that is what they're spending their time doing. That's that discounted cash flow model that I use during the share, how to value a share webinar. So that's where we're using that discount cash flow model to calculate a fair value. So that's what they're doing. They're calculating a fair value. Then they're incorporating a margin of safety in here. So you can see that for those of you that can do math, we're still we're $17. I'm not one of the people that can do math. We're still $17.50 below or above fair value here, but it's equating to, and you'll see that Apple's not a good example because it's not undervalued, but you'll see that before you get into a 5-star price, even though we think this thing is worth $115, it would have to get to $69 to be a 5-star price because we're looking for that buffer. So that's the margin of safety between $69 and $115. And then, of course, the moat. So we calculate an economic moat, and you can go through and read why our analysts think people have economic moats. So switching costs and intangible assets are the two for Apple. Intangible assets is basically brand. People like iPhones. And then switching costs it's a pain in the ass to switch. We see this a lot around banks, but I think it's a pain in the ass to switch phones. Like I can't even do switching from a current iPhone to a former iPhone, or vice versa. Former to current, but certainly switching to a different brand, and same thing with Android, right? People become very used to certain things. All right, we got a lot of questions, so I guess we're not getting out of here early. All right, so let's go through the questions. Okay, so we've got a question from Randall. So Randall says, is the P ratio a way of determining value? Okay, no. So I would say, let's talk about the P ratio. So P ratio, or any sort of price to anything ratio, price to cash flow, price to book value, these are all relative valuation techniques. So what does that mean? It means the number by itself doesn't do anything for you. You have to compare it to something else in order to have that number have meaning. So what we're doing by dividing price to earnings, what we're doing by that is we are making it so we can compare lots of different things. So you could compare two companies. So a company could have a PE of 10, another company could have a PE of 15. That allows us to make the statement the one at 10 is cheap. Doesn't mean that it is worth a certain amount or undervalued or anything else. It just means it's cheap compared to the other company. Of course, we can compare a current company's PE to a historical PE. That can say it is cheaper than it was before or more expensive than it was before. We can compare a PE to a sector-wide PE, a market PE. So they're all relative valuation techniques. But what I'd be very careful with is a lot of people think that this is just a magic number, that we can just take this number and all of a sudden we know exactly that we can make all these comparisons. But you have to understand the company to understand if the PE is telling you anything or not. And the reason I'm saying this is because you could have a very, very cheap company that's about to go out of business. So if you don't understand the company's financial situation, if you don't understand their competitiveness in their industry, you can't assess whether that cheap PE means the company is cheap and temporarily undervalued, or it's cheap and it's about to go out of business, or is a terrible company. Same thing on the higher side, for quality stocks, and that's what Buffett was saying. For quality stocks, we're going to pay more. Investors are always going to pay more. Now that could be worth it. It could still be cheap relative to what it's worth. But if you're using a PE to compare a company to its peers or the market, and it's more expensive, well, that extra that investors are paying could be justified. And of course it could be justified in a simple way of looking at this through growth prospects that the company has. Because the PE is backward looking, it's looking historically. So if you have a PE of 20 and the company manages to double its earnings the next year, well, all of a sudden the PE is 10 if the share price doesn't move. So be careful with PE. I think people use that, and we use it too, and it's something that's important to look at, but it has to be done within the context of the industry the company operates in and the company as a whole. All right, here we go. A good question by Lisa. Not asking if people need to be nut jobs this time. So she's saying, is value investing still relevant today, especially in light of the dominance of giant tech stocks? Okay, so a couple of interesting things about this. So value and growth investing is just, we are dividing up shares by ones that are statistically cheap using ratios like PE. Once again, we're comparing them versus ones that are statistically expensive. We're not looking at fair values, any of this stuff. What we're looking at is just where they fall on price to earnings, price to book, price to cash flow, things like that. So we divide the universe into growth and value. Now, Buffett would argue that value investing doesn't necessarily need to be a traditional value stock. So Lisa said, especially in light of dominance of global tech stocks. So yeah, we've had this huge run up in tech shares, basically, and growth stocks at the end of the day. There hasn't been a rotation back to value for a long time, since the GFC, basically. So, but Buffett would argue that where something falls on the growth to value spectrum isn't really important. What's important is comparing the stock to what it's worth. And that's what our analysts are trying to do by calculating that fair value. So an example of this, of course, is Apple. Nobody would ever say that Apple was a value stock, but Buffett still saw value in it in 2016, and it's still his biggest holding, right? Even though it's had a huge run up. So yeah, I think more about value versus what something's worth and sort of these traditional measures of growth and value. That being said, there's obviously been this huge run. At some point, there's going to be a rotation back to value, so we'll see when that happens. All right, so I've got a question saying, what is the meaning of the wide and narrow moat ratings? It's just how long our analysts believe that sustainable competitive advantage will continue. So for wide moat, they think it will last 20 years. For narrow moat, they think it will last 10 years. So obviously, a company can maintain the sustainable competitive advantage, but over time, that could be eroded. And really, that's just giving a time frame that our analysts think on it. All right, so we've got a question saying, how does an investor look at moats? Which is better and when? Okay, Yeah, my argument would be, of course, that if we're looking to be great investors, besides being nut jobs, like I said, and then Lisa pointed out, the other thing, of course, is as Buffett was talking about, we want to buy great companies and we want to buy them at compelling prices. So the great companies part, in Morningstar, well, in industry speak, is a company with a moat, with a sustainable competitive advantage. Now, our analysts are going out and giving their opinion on those, rating those moats, or rating companies with a moat rating. So yeah, our analysts believe those are great companies, but then make sure you take price into account. So look at those two things, quality and price, when you're thinking about what to buy. Okay, so we've got a question from Michael. So Michael said, when Buffett bought Apple, it was 1 star. Doesn't that mean he was paying too much? So I don't think it was actually 1 star back then. Let me go back and check. But I will say, obviously, this is, all right, I'm going back to 2016. So it was 3 stars. So in 2016, our analysts thought it was 3 stars. Now, to be very clear and to be transparent about what happened, and I'll show you what I'm looking at, because it's a lot better than looking at me, I believe. And so I've been told by everyone. All right, so this is basically our price to fair value over time. So if we go back to 2016, yeah, there are points in 2016 it was 4 stars. And then it changed to 3 stars. So we do believe that that was a 4-star stock for high quality, like not a bad value, right? You can see right here in July 2016, yeah, it was a low of $23.59. We thought it was worth $33. So yeah, in 2016, it had better valuation than it does now. Obviously, there's been a huge run up. So it's $33. Now we're at 132, which is nice if you bought it back then. Okay, so sorry, still gonna keep going through the questions. Now you gotta look at me again. But this will encourage people to ask questions where I can bring up a chart. All right, so we got a question from James. So James is asking, now I'll get your question at the end. How about that, James? That will be better. All right, so we've got a question that relates to a previous webinar. If you want to swap out VanEck's moat for one of the model ETFs and model portfolios, what is the nearest equivalent? Okay, so let's talk about, it would be anything that's sort of quality related. So we do sell our moat ratings. So basically we create an index with our moat ratings. So they're companies that have high moat or good moat ratings, I can't speak. They have wide and narrow moat ratings. We sell that index to VanEck. VanEck has created an ETF. We do not rate this ETF, of course, because it'd be a conflict of interest, but the ticker symbol on that is MOAT. M-O-A-T. So you can go look at that. So yeah, what I would look at, depending upon if you're looking at domestic, I would look at those Aussie equity ETFs that we talked about. That could be the substitute for that. So in our mind, certainly that that MOAT ETF is something that denotes quality. So buying quality companies. Okay, we've got a good question from Travis. So Travis says, I have a question on moat. How often does Morningstar review a company's moat? So he's using an example, A2 Milk has a moat, but clearly is not loved right now. Same. When would Morningstar reassess, and what do you look for? Okay, so our equity analysts continually follow all the securities that they have, and they take this moat thing pretty seriously. There's this moat committee. It's all a little dorky, and I make fun of them for this, but there's this moat committee, and they have to present to the moat committee, and they reassess this. So I will say that this is a continual process. Obviously, like every day, we are not looking at the moat, but it is a continual process. And there is a set structure around it that happens. So A2 Milk, hasn't done great right now. But remember, the moat is long term. So when we're talking about sustainable competitive advantages, what we're talking about is the return on invested capital. Those margins are going to accrue over time. So we need to be very long term when we think about this, and we think about sort of this Mr. Market idea of sentiment that, of course, course, stocks can fluctuate in value, and they do, and they fluctuate based on the news. Now, that doesn't necessarily impact the moat. I would be more focused on our valuation levels, where our analysts will adjust their price to fair value if they believe it's warranted. If it is just sort of market noise and they don't believe that the news that's coming out is going to have a long-term impact on valuation levels, then yeah, you're not going to see those adjustments. All right, so the anonymous attendee, one of many anonymous attendees. I wish I could be anonymous during these things. Should I keep my share portfolio for the long term or sell them if my shares increase in value to get some money back? Well, I, of course, can't answer that question. That is very, very specific to your own personal circumstances. So I can't answer that. What I will say is that we are proponents of long-term investing here at Morningstar, but of course, we're also proponents of goals-based investing. So it depends what your goal is. So I'm sorry that I can't answer that, but the New Zealand regulatory authority will come over here and get me if I try to answer that. A good question. With the current growth stocks rising higher and higher, is now a good time to rotate and focus on value stocks to protect from a bubble burst? Once again, I don't know what's going to happen with the market. I personally believe that the market's overvalued. I believe, and we've done a couple of these on the past, that there's a lot of speculation baked into the market right now, and we're seeing some very scary things that certainly historically have indicated that we might be in a bubble. I don't know. There's been a long, if you type in Morningstar growth versus value stocks, you can see column after column that we've written on this. This has been an unprecedented run without a rotation back into value. Now, we had this before. Notice how I just said it was unprecedented, and then I'm now talking about how this happened before. So I take back that unprecedented word. This is a very rare run on growth stocks. I do know at least a little bit of the English language, despite my American accent. So this happened in the 90s, of course, as well. So we had this huge run up. And then when we had the dot-com bubble burst, go back and look at growth versus value then. So value quickly recovered, naturally went up as the dot-com bubble was bursting, where of course the NASDAQ went down 75%. So historically, there have been times where after a long run, there was a hard rotation back into value as a bubble burst. Obviously, I don't know what's going to happen right now. All right, the anonymous attendee says, suggestion for a future seminar. I'd love you to run a seminar, how to use Morningstar tools or resources to develop a plan for sector diversification. See, even though this is an anonymous attendee, I bet you this is Fergus. So if it's Fergus, I'm on to you. That's because this guy sends me very thoughtful emails, and he talks about that, and I agree. I think we should do something on that. All right. Okay, we've got a really good question from the anonymous attendee. What is a reasonable margin of safety? Okay, so reasonable margin of safety. So what we look at here at Morningstar in terms of a margin of safety is we look at the uncertainty level of the stock. So, getting to the minutia of our ratings. Okay, we have an uncertainty level on each one of the shares that we cover, and what that uncertainty means. So once again, remember, we are estimating a margin of safety, or we are using a margin of safety because we understand that there's a lack of precision in calculating a price to fair value. And we understand that the future is, of course, unknowable. That's why we use a margin of safety. So depending upon the business that a company is in, depending upon the markets they operate in, depending upon their structure, are they more leveraged? Do they have lots of debt? Those can all indicate higher uncertainty when our analysts are trying to calculate out that 10 years of future earnings and cash flow. So companies with higher uncertainty require a larger margin of safety to account for that lack of precision that our analysts believe are going into their models. So you can go look at the uncertainty rating. So you can see Apple is higher. And basically what that uncertainty rating will do is it'll automatically translate into a star rating by putting different bands around those star ratings. I wish I had a slide that showed that. But what you can do, if you go into Discover Investments, you go into Investment Filters, Add Filter. If I do a stock filter, I can look at that uncertainty rating. In theory, if I can find it. No, it's in valuation, isn't it? It's embarrassing when I don't know where stuff is since I wrote the requirements on it. Where, but there, fair value uncertainty. An assessment of the firm's cash flow, predictability, or valuation risk. So you can go through and look at, just by using the screener, you can pick whatever you want and look at different companies that have lower uncertainty ratings and higher or extreme uncertainty ratings. So high is in the middle. So that will automatically adjust that band or the margin of safety that indicates a star rating. So a 5-star stock, which is our cheapest stock, if something is extreme uncertainty, there's going to be a lot bigger band. I think it's 70%. So we want to see a fair value that is 70% above the market price that it's currently trading at for us to call that a 5-star stock. So hopefully that answered your question. Okay, so Randall's saying, how do we assess your estimation of a company's fair value? Literally, just look at any of those. Well, you can take a trial out or sign up for a premium subscription. But yeah, for every single stock, just put in the ticker symbol, and it'll be on that first page, that analysis page. You'll see it on that weird, like, capsule chart thing. So it will be right there. All right, so we've got another... Okay, so let's talk about, so we've got a question. I'm not very good at explaining stuff, unfortunately. So we've got a question about the definition of a growth stock versus a value stock. So let me go back to this. So we've got this thing called the Morningstar style box. Here we go. So basically what this looks at is market capitalization. So those are big stocks and small stocks. And then we've got growth versus value. So I can find a bunch of growth stocks. So what am I looking at? I'll just throw in a Morningstar rating. How about that? Just so we can see stuff that we cover. I'll take that off. That's going to go through and search through 43,000 stocks that we have. And then basically you can see this equity style box right there. Okay, so when we're looking at growth versus value, and if we go back, or we go back to this filter, you can see growth versus value versus core. So basically what we are looking at, and different people do this in different ways, what we are looking at is a series of indicators that we're just ranking stocks in, and then dividing them into those buckets. And of course, core are just things in the middle. So we're looking at price to earnings, for example. We're looking at price to book value, price to cash flow. We're just looking at different indications that a stock is statistically cheap. Now, that doesn't mean that it shouldn't be cheap, because it's a terrible company. So once again, with any of those measures, with any of those relative valuation techniques, we can't just use them without context to figure out what we're actually looking at there. So that's how we're dividing up that universe. Now, this is different from a manager who says they are a growth manager or a value manager. Because of course they can use their own criteria, and they can use their own criteria to select investments that go into those different buckets. So just be careful, because those two things are different. So that's why if you go and look at a value fund or a growth fund, you should go in there and look at and read, particularly for an actively managed one, read the prospectus on that, and go in and look at the criteria that those managers are going to be using to select those. And if you go and you buy a passive like ETF, you can go buy a growth ETF or a value ETF. Go in there and once again read the documentation, and you can figure out how they are ranking those different companies. But just remember, and sometimes they use momentum for growth, like price momentum and stuff like that. But just remember that those are all just different ways that, those are all different criteria to just slice up the equity universe. So sorry, that was a longer answer. Okay, we've got a couple more minutes. So there are a couple other questions that we have. Let's see, what do we got? We're back to our nut job comment. Sorry, I should be more organized with my questions. All right, I think we actually got most of them. So the one, if you can send me an email at mark.lamonica1@morningstar.com. I get asked this a lot, so I do have a good list of books that I can send through to you that are more recent than something that was published in 1949. But yeah, James, if you could send that through. If anyone else wants a list, send through that question. And then you can, anyone can email me any questions at mark.lamonica1@morningstar.com. So we'll be back on Thursday, and we are going to talk about getting your portfolio prepared for retirement, which is exciting. I am prepared for retirement. My portfolio is not. Anyway, thank you guys for joining, and send through any questions that you have.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.